Welcome to the Dividend Talk podcast, episode 216. Manny Mysteries Fire Journey. Hey guys, welcome back to another episode of Dividend Talk. This week, we've got Manny Mystery, who's a member of our community, who's going to speak about his journey to financial independence. I'm sure this will resonate with a lot of you, so let's get straight into it. See you on the inside. Hey, European DJ. How's your weekend been?
Very busy, like the last 10 episodes, Mr. Derek. But rain has started here finally. So autumn is starting, leaves start to fall. So the dark days are coming. I'm actually looking forward to it because I don't mind reading quarterly reports in the upcoming few weeks. But actually, I'm also very excited today because we have a long-time member from our Facebook group and the community today as a visitor, and that's Manoush. Manoush, thank you so much for joining us today.
Thank you very much. Great to be here, and thank you for the invite. Really appreciate it.
Yeah, I'm always more excited when we have members of the community on rather than because we've had some big guests on that have a large following, say, but I find more value in having the community on because the stories are real, the real people behind them, and it always kind of inspires me. So I know a little bit about your story, Manny, but I can't wait. Honestly, I can't wait to chat to you and learn more about your investing and how you've progressed through that. But maybe just for our listeners, for those that don't know you, if you could just give us a brief introduction, your name, which I probably pronounce wrong every weekend, and just a little bit about yourself.
Yeah, absolutely. So my name's Manny Mystery. Most people call me Manny. That's my handle on Facebook as well. In my mid-50s, born and raised here in the UK in the Midlands. I'm a consultant. I run my own consulting business. It's more technology-led growth strategies that I advise on for my clients. I've been investing for probably since 2013 is when I first started actively investing, and my investing journey's evolved over time, and I'm at a stage now. I think I'm a couple of years away from retirement, and I think my portfolio and my investing strategy has evolved to a stage in which I think it will stay this way until retirement now. So I'm very happy to be in that position.
Wow, a couple of years away from retirement sounds really, really nice. So we'll catch up on that later on. I have quite a few questions for you already.
Okay.
But before that, I know you listen to the show, so you're probably aware, but we usually have some news of the weekend. Mm-hmm. European DJI, I've been gone all weekend, so I'm leaving this in your capable hands.
Yes, thank you, Derek. And by the way, Manoush, I started in 2014 and I'm also there in a few years. So we're really kind of at the same track. So I'm also very curious to learn more about that. But hey, look, last week we had a show about high yield dividend investing, and it triggered quite some responses from the community as well. And we had a few people reaching out, and one email that we get from Canadian DJI, I would really like to share a little bit. So allow me, please, 2-3 minutes to read it up because it is very interesting, and I think more of our listeners should know about this. So I just read it up a little bit, not the entire email, but the highlights out of it. He says like, hey, being Canadian, we share many unique considerations such as taxations and overweighted industries compared to the Americans. Your podcast has been both educational and enjoyable. However, the greatest impact was emotional. Employing a lean FI strategy in my early 30s came with the surprise-free gift of the imposter syndrome. And he mentions a bit more about that. And, you and I are actually making this podcast to really share our journey with others and to inspire, right? So I always love to read this, but I will not go into all the appreciation that he has, but more into his investing thesis. So he says, my investing thesis is that a high distribution strategy is the most accessible style for the average person to reach financial independence. Due to this accessibility in ease and speed, I believe it should be discussed much more broadly and freely, which is very interesting, right? Taking high yield dividend investing into relation of the accessibility of ever reaching financial independence, where he has a good point, I think. What he says further is my story falls on the other half of the population that does not like their job, because he's saying like, hey, one of the half of the population likes their job. Maybe they don't have a need for financial independence, but what about the other half, right? So after 12 years of diligent saving, I had two options on how I could fund my life. The first option is to stay working in product marketing for another 10 to 15 years before reaching a big cushy FI number. The second option was cashing out the non-registered part of his portfolio from 100% boring index funds into a high dividend strategy. So he started his high dividend strategy about 2 years ago and has not looked back. Without going into specific numbers, he has about 50% of his investments in a 9% yielding portfolio and 50% in boring broad index funds. Then he says, as I adjust my interest in life, my 9% portfolio cash flows me a modest monthly stipend that I live off in an IO-ish cost of living city. The broad index funds are all in registered accounts based on tax optimization, and he plans to live off the 9% portfolio for the next 20 years, at which point he has access to the 50% boring funds, which will double his investment income. So those are probably those from a government favorable, tax favorable account. What he then says is the 9% portfolio is built with 3 equal weight objectives. 1, provide sizable and reliable income to fund his lifestyle now. 2, provide long-term capital appreciation. And 3, minimize the tax burden. His effective tax rate on the distributions from his 9% portfolio is minus 2% due to the eligible and I believe it's called return on capital type dividends alongside no employment income. So effectively is getting already capital gains out of it, not real dividends. I think that's what he's talking about. His portfolio balance year to date in 2024 is up 19.2% compared to the 21.9% of the S&P 500. I think this is amazing because, you know, he doesn't own as such NASDAQ or something like, NVIDIA here. Although, you know, when you refer to 9 ETF holdings of equal weight, 25% international SEFs, 25% Canadian high dividend, and 40% covered call, 10% USD bill covered call. That's his strategy there, with a dividend growth rate of about 2.5% to balance inflation. As is often said, there are no free luncheons. There are 3 significant downsides to his 9% portfolio strategy: generally lower total returns, higher local market allocation, because he's mostly invested in Canada, and what he calls the dead dollar conundrum. The ROC type dividends he receives lowers his cost basis dollar for dollar, so selling the funds would create a large capital gain event. So look, this is very interesting. He says also, like, look, in the end, it is a simple trade-off, right? Either you continue with your historic full-time working hours and retire more comfortably later, or live in a more modest retirement life now. What do you choose, right? That's really the question. He personally has appreciated the non-financial benefits the most, avoiding the stresses of modern working life combined with time to improve one's mental and physical health provides the real intangible dividend. So I wanted to share this because it's a story we actually never really discussed on the show here. We were also talking about this last week, that we often have this feeling like, oh, I could easily double my dividend income and retire today, right? This guy has done it, and it's nice that he connects it also to the mental health and the stressful life that he has for now, while in 20 years still getting income. I find this very inspiring, and yeah, also to see the capital gains of 20% this year is actually very impressive. So, you know, sharing this, but also curious to hear what both your thoughts are when you hear this.
Yeah. So actually, it was quite a nice email. You sent it on to me today, and it was actually quite refreshing to read that somebody has done that. They've admitted, look, I'm sick of my job, and took action and took money out of their ETFs and put it into high yield instruments. And that takes, I would say, balls of steel to take that risk, especially if you're planning on leaving work. The only thing I'd say, we do share a lot of similarities, but Canadians have easier access to some of these types of funds. So these closed-end funds that we spoke about, these high-yielding covered call ETFs, which I may or may not be a fan of, but it's harder for Europeans to access them. And if we do, there's ways around it. There's still this risk of estate taxes and all these other junk that we have to go through afterwards. So I still want to hear from a European perspective how it's possible to have this type of portfolio. Yes, we can do it with single stocks. We could pick Legal and General and all these types of, but there's a lot more risk, I think, for Europeans. But it was actually a very balanced view of the upsides and the downsides. It laid it out all on the table, and it's quite inspiring. And if I lived in America or Canada, I would find it a lot easier to follow this type of plan. But as a European, I'm struggling really to do that.
Yeah, I think for me, when I hear that, he reminds me a lot of another vlogger, and he's Canadian also, and I forget his channel's name, but he lives with his wife currently in South America, I believe, but he's also maintains a home in Canada. But very much a portfolio that is highly focused on these covered call ETFs, right? And actually, a covered call ETF forms part of my portfolio as well from this year. And with those types of ETFs, you can actually achieve a 9% yield. So it is possible, although I have that myself, but I'm dedicating a large proportion of my portfolio to that so that I can live off the dividends. It sounds quite risky to me, and yeah, absolutely balls of steel, right? This guy is going out and doing that. I kind of feel like I probably wouldn't take that amount of risk with my portfolio, but I do recognize this use of covered call ETFs, and we can get them here in Europe now, or at least in the UK. And I can talk about that later in my portfolio. But it's generating at least 9% dividend yield.
Are they UCITSs, or are they your standard American style ETFs?
UCITS, yeah.
Oh,
yeah.
okay.
Yeah, there's two. There's one that's a Nasdaq 100, and there's an S&P 500 based covered call ETF. I've gone with the Nasdaq one myself.
Perfect. Okay, we'll definitely be talking about those when we get to your
Guys, I think the main difference between you and Canadian DGI is that you don't hate your job as much as he does, probably at this moment in time.
Yeah, absolutely. That's a real driver.
Because I know quite some people that are just unhappy and fed up with their jobs, and it really struck a chord with me when he said about accessibility to FI. Imagine you're in the unfortunate position that you just really hate your job, but maybe even the industry that you work on. Imagine the effort it would take to re-educate yourself, reskill yourself, to go into another industry. And I can imagine the temptation then to just like go for high yield and just say, guys, call it a day here.
Yeah,
I'm going to retire. I can imagine this risk behavior then if you really don't like and it just makes you depressed, let's say, because there are a lot of people in the world that are literally depressed just because they don't like their job, and they bring that home.
Yeah.
Sorry, go ahead.
Yeah, I feel the risk is only monetary though, and the benefits outweigh that.
Exactly.
He spoke about mental health and all this, and I'm actually so impressed and really inspired by this email that he could just say, I don't like my job, and he'd go and do something about that, and he's took steps to do that, and that takes a lot of courage. And we get challenged by, even Ron recently sent us an email and said, hey guys, you say you like work, but how can you work for a boss that can tell you when to take holidays the whole time? So even when you like work, there's always still restrictions around that, whereas taking action and giving yourself the opportunity to be free, you take all that away from everyone. And Canadian dividend investor, I'm hugely inspired.
I would agree with that. I mean, being self-employed for the last 11 years, the thought of getting a job with a boss that tells you what to do, I don't think I could go back to it. It would be tough. It would be really tough.
Good. Hey, Manny, to get to know you a little bit better as well, we typically do a rapid fire round. So the idea here is I will ask you 5 questions with 2 predefined answers, and you need to choose one of them. And then at the end of those 5 questions, you may still, explain a little bit on 1 or 2 of the questions or answers that you provided. Are you ready?
I'm ready.
Okay, born ready, I see. There we go. What criteria do you prioritize when selecting dividend growth stocks for your portfolio? A, strong historical dividend growth, but maybe a low payout ratio, or a higher yield, but a high payout ratio, but also maybe lower dividend growth.
There's a strong dividend history with a lower growth.
Awesome. Would you rather have a steady dividend with no growth, or a volatile stock that pays no dividend but has the potential for massive price appreciation? Think about Nvidia or something like that.
Steady dividend, no growth.
What type of reinvesting do you prefer? Always reinvest back into the same stock if you could, or deploy the money elsewhere in the next attractive opportunity?
Deploy elsewhere.
If you could only invest in one sector for the rest of your life, would you choose high growth tech or traditional consumer staples?
Consumer staples.
If you could have dinner with any company's CEO to discuss dividends, who would it be? And what's the first question you'd ask? A, Warren Buffett. What's your secret to selecting dividend stocks? B, Elon Musk. Why don't you pay dividends? And when will you start?
Elon Musk. Why don't you pay dividends?
Awesome. Any answer you would like to provide more clarification on?
No, I think we a couple of interesting questions there. I'm a really firm believer in, and I'll talk probably later about the my ethos around Income Factory from Steve Bavaria, right? And it's because of that I kind of tend to favor investing in companies that pay a regular, stable dividend as a preference to growth. Either in growth in the share price or even growth in the dividend, right? I like dependability, and I don't kind of focus on growing my dividend income by the dividend itself growing or the share price growing, but actually just buying more units of that company and growing it that way. And that's why I'd rather just have a strong balance sheet and dependable dividends. And if they don't grow each year, as long as they don't drop, if they don't grow but they stay stable, that's more preferable to me.
Yeah, thank you. And why Elon Musk over Warren Buffett?
I think Elon Musk because I really sometimes like to understand. I think Warren Buffett because we know so much about him, and he's been asked 100,000 questions that we've all had answers to before. And we really know what he's all about. Whereas with Elon Musk, one of the things I'd really like to understand is what is his motivation with his empire, right? Is his motivation personal in terms of his personal need to grow an empire? Maybe it's an ego thing, or is it his interest in delivering to his shareholders? I don't feel that Elon's main motivation is delivering to his shareholders, and that always makes me kind of not skeptical, but it almost makes me feel as if he's not serving the right people.
Yeah, Elon is mostly invested in Elon.
Yes.
Yeah.
Yes. So maybe that is the right person. He's serving himself. So who knows?
I used to have a friend who worked actually for him, reported to him for a while, and he left after 2 years. He said, "I can't stand the guy. I've had enough of him." I understand why.
Awesome. Yeah, so that kind of piqued my curiosity why Elon Musk, but when you explain it, it makes perfect sense. It's probably the best option of the two. So I think we'll jump straight into the main topic, and I think you wrote a post on Facebook, if I am not mistaken, which European DJI reached out and asked you to come on the show, and you did, but you spoke about and you touched on it, your Income Factory ethos, which we know we're mad to get Steve Bavaria on the show. We've reached out to him, so hopefully he'll come on at some point. I see he's doing YouTube and those types of things, so maybe he'll come on. But I've read that book too, It's very interesting. I've allocated a small portion of my portfolio to it, which me and European DJ talk about all the time. But it's quite interesting to hear how it's worked for you and how you're reaching your retirement goals based on that. But before that, you've said that you've been investing since 2013. And you've changed and perfected your craft over time. But what did it look like? How did you get started way back?
I got started when I moved to Canada. And I've never been into investing at all. But at the time in Canada, they had this benefit. The government had this benefit, or at least in Ontario, where if you took out a loan and you use that loan to invest in the stock market, you could write off the interest payments on your tax returns each year. It was a way for them to encourage people to invest. So I really wanted to start to think about it, and I took the I think it's called Canadian Securities and Exchange course, which is really it was just an online course. It was about how to invest. So I started to learn very basic fundamentals about investing in the stock market. And what I did was I thought, before I put any of my own money or borrowed money into it, let me just do it on paper. Just decide, okay, here's a company I'm interested in. What would happen if I said I'm going to put $10,000 into this company, for example? And I missed a 100-bagger, right? Because what I did was I said, oh, this research in motion, that seems interesting to me, and it's 3 cents per share. So let me pretend I'm going to put $10,000 into research in motion. The guys who made BlackBerry, which was at its initial stages. And before I knew it, it was $3 per share. I thought, my God, I've just missed a great opportunity, And I actually did something similar later for real. But that kind of made me think, there's something in this stock investing, right? That you can actually make some very, very good money. But the reason when I came back from Canada, I forgot about investing, and then I came across this story. It's about a guy, a British man who was a soldier in World War II. After the war, he came back, and he got married to his girlfriend. And he just took a job. I can't remember what the job was, but it was a steady job. And he was one of these guys who just did a steady job, paid his bills. And with the extra money that he had left over, he just bought shares in a large British company that had been around for a long time. I think it might have been NatWest Bank or something like that. And every month he just did that, right? He just put his extra income, he bought more shares, and he just put them away. And over time, they just forgot about it, or his wife forgot about it. And in his 70s, he passed away. And it came time for his wife to take on the inheritance. And so, the lawyer said, okay, here's the house, here's the savings, here's this, that, and the other. Oh, and by the way, do you remember your husband used to invest in these NatWest shares, every single year? And she said, yeah, how much is it worth? And he said, £2 million. Right. And that really struck a chord with me. That's the first time I really thought about compounding, right?
Yeah.
And that's when I really said, I obviously regretted I hadn't heard this story 10 years ago. It started earlier, but that's what really got me into investing. And then kind of life threw me a lot of curveballs. This was around 2003, and then my life kind of had a lot of ups and downs, mostly downs. It's just life sometimes throws you curveballs, and you just end up with no ability to save any money. So I didn't really get a chance. It was only until 2013 that I was very, very financially comfortable, and I was able to really think about investing properly. So that's when I really opened a SIP and a self-invested pension plan. And I started to actively invest money. And at the beginning, it was very simple. It's just UK companies. I was buying things like Royal Sun Alliance, preference shares, Aviva, BP, Vodafone, things like that. Just based on the little research that I'd done on, online kind of sources like Seeking Alpha or Motley Fool, things like that. And that's how I really started to invest. And then over time, I started to really refine that. Oh, by the way, there's a great exercise that anyone can do. Look back at your historical buys and sells, because I actually invested in Caledonia Mining at that time at 8.5 per share, and I sold it at 96 pence per share and made £10,000 profit, which I was very happy with. Except if I held it till now, it would have been £11.30 per share, and I would have made £130,000. So I would always say to people, don't be too quick to sell your gains, your big gains, right? Because you just don't know. But then I kind of moved on to then really start to look at the US as well as UK. Started to understand that, and even to this day, I've found that US companies are more shareholder friendly.
Yeah.
And started to invest in companies like AT&T and Intel and McDonald's. Again, companies I sold way too early and I should not have. And I started to do that and really started to expand just the breadth of what I was investing in, and started to look at some high level kind of ratios, which I hadn't before, like debt to equity, current ratio, return on capital employed, and stuff like that. But just very high level PE ratio. I started to understand what that was. So it wasn't until about 2019 when I came across a vlogger on YouTube, a guy called Hamish Hodder, an Australian guy, that I really started to understand discounted cash flow and fair value calculation. Because one of the things I always kind of felt was that whilst I was investing in companies that I thought was strong, I had no idea whether I was buying them cheap or buying them too expensive, and that's when I started to look at DCF and fair value and things like that. And then I came across you guys and I started to listen to you guys, and I know you have their own methods of discounted cash flow calculations and things like that, right up until this day now, where now I do the full gamut of analysis, where I will look at I'll pick a sector, and the kind of sectors I like to invest in are sectors that produce products or services which we just can't live without. Those are the ones I really like. And so what I'll do is I'll pick 3 or 4 competitor companies in a particular sector I'm interested in, and I'll do a comparison based on the data from its last financial statements. And based on what I see there, I'll decide which company it is that I'm interested in. Then I'll do a full 10-year analysis of it, and based on that, I'll do the DCF and fair value calculation, derive the price that I want to buy it at. So I think I've got my analysis to a stage where I know what I want to invest in. I know how to derive my fair value or my buy price and buy range, if you will. And then this year, when I'm kind of getting close to retirement, is when I decided, right, I was 100% in individual companies. I really want to start to have the majority in funds. And I think it's about 72% in funds, and the rest is in individual companies. I was really always reluctant to look at funds because I felt that I wouldn't be able to achieve the yield that I want to, and my minimum yield I want to achieve is 4%. But actually, the funds that I've found over a lot of time, trial and error, and looking at funds, I'm able to achieve more than 4% on all of my funds at the moment. So I'm very happy with where I'm at currently, and kind of that's how I've kind of allocated it. I've kind of said, look, I'm going to put 50% of my portfolio into fixed income funds, 23% into equity funds, and then 23% into just individual equities and individual companies, and leave 4% in cash. But I hardly ever achieve 4% in cash because I just like to deploy as much cash as possible to, drive that income.
Yeah, it's quite a story, and listening to the beginning and where you are in 2013, it seems like you were more interested in price appreciation, from what I heard. And at what point did you start to focus on dividends? I know you went to the US and you're investing in AT&T and these, but you mentioned you sold them too early. So to me, that sounds like you were looking at the price of them. So what point did you switch to dividends and dividend growth?
I think I've always been interested in dividend growth. I think at the early stages, I was trying to achieve a reasonable dividend yield whilst also investing in companies where I could see the increase in share price. But it was only after a while that I kind of thought, I love the income so much. Why would I ever want to sell? Right. So, but I ended up, I think I was quite lucky in that. I don't know whether it was lucky or just I picked the right companies. But generally, when I'd sold and I sold at a profit, and then, I mean, I made losses on certain things, obviously, but generally, on the whole, between 2013 and 2022, I actually made a lot of profit. I think in total, around that time, made about £55,000 just in profit. Right? It wasn't. I didn't sell because I wanted to make a profit. I sold because it wasn't the right company for me anymore. I wanted to put my money into better companies that are less risky but still had a good yield. It just happened to make a profit when I sold them.
Oh, awesome.
Yeah.
So then you transition more into then these funds, these ETFs, and what's your thought process around them? How do you pick a fund now when you're selecting?
So the way I've picked them is I wanted to get a good balance between fixed income and equity funds. And where equity funds are concerned, I wanted to make sure that I had a good geographical split, because with funds, you tend to kind of buy a lot of the global funds tend to be heavily weighted towards the US, right? And I didn't want that. I wanted to pick a variety of funds that gave me a broader geographical split in the developed world. Now, that's not to say that I don't think that the US is strong. I think it is strong, but it's also overpriced, right? So what I do is I wanted a geographical split of funds so that I could actually start to move my money from one region to another based on how expensive it is. And the way I do that is to look at the PE of the major indexes around the world. So UK and Europe, for example, if I find the PE is lower than the US, then I might want to, increase my weight to UK and Europe funds compared to US funds, and vice versa. And so that's the reason why I didn't like a lot of the funds that were heavily weighted towards the US. So now I think with my equity funds, I've got a good split of US, UK, Europe, mostly those. Some, I don't think I have any emerging market allocation in any of the funds at the moment.
Awesome. And, with that, I think you have also answered straight away a few questions from Richard Falcon and Philip Zimek. And, you mentioned you're like 2, 3, 4 years, let's say, from your target retirement date.
Yeah.
But how do your friends and family actually respond to your need for financial independence like that?
Well, I would say my immediate family, so my wife and daughter, at the beginning, I think my wife was a little bit kind of worried that I was allocating too much of our family wealth into the stock market or into bond funds and things like that. But like other things that I've done, once she sees the results, then she starts to get a lot more comfortable with it. For a number of years, I've been quite an avid poker player, right? I love playing poker tournaments, and similar thing there. At the beginning, she's like, "What the hell are you doing? You're throwing money away." But then after a while, she realized that I'd learned how to play really well, and I was actually making money. It was almost like a side hustle, and then she started to get a lot more comfortable with it. There's a lot of good parallels between investing and poker, right? I could go on for hours about it, but I think that's what it is. Now, with friends and extended family, when they understand what I'm doing, there's 50% of them, about 50% of them will say, "Great, tell me how to do it, because I really want to do this." But then putting it into practice becomes very difficult, because as soon as they learn how much study and how much you have to learn how to do it, because I've had a lot of people say to me, "Why don't you just tell me what you invest in? I'll copy you." And I never do that, right? Because my assumptions and my attitude to risk is different to theirs, right? And I say, I'm not going to do that, but I'll tell you the books I read. You can read those, and I'll show you how to calculate what I calculate. And half the people don't want to do that amount of work. And the other half kind of understand that it's a lot of work, and so rather than do that, they say, well, I'd rather just invest in a fund and let fund managers do the work for me. And so that's a completely valid way of doing it, right? And there's nothing wrong with that. I just think that, and maybe it's optimistic or ambitious of me, but I think I can beat a lot of fund managers out there. So I think I can do it.
At least the fees.
And the fees, minus the fees.
Yeah.
I think that's the one reason why I avoided funds for a long time, and especially active funds, and especially financial planners. There was a financial planner who approached me some time ago and said, look, I can do this and I can do that. And I said, okay, great. So if you claim you can beat the market and you don't, then can I have my fees back? And he said, well, no, we don't do that. And I said, well, you want me to pay you to fail? I don't think I'm going to do that. I'd rather learn it myself, right?
Yeah. It's interesting what you mentioned also. Sometimes I'm just thinking to just give books to people, investing books, and just write one thing in the inside of the book, and that's good luck staying poor, because you know that the person probably doesn't even read the book. Yeah, and maybe at least this quote would trigger them more like a negative response, that they think like, okay, now I'm going to prove him otherwise.
Yeah, absolutely. But I do find that I have a lot of Canadian friends, and there's this thing in Canada where when they want to learn something, they pay thousands of dollars to go on these courses, seminar type courses, and I'm kind of like, all that information is free online. You just got to learn it, right?
Yeah,
it's strange.
That's funny.
Yeah.
So, well, you just mentioned already then a little bit about your portfolios setup and how that ideally looks like, right? But what is currently your average dividend yield and dividend growth rate? This was Centrino is also asking about.
Yeah, so currently my yield is 6.7%, and the growth rate is 3.75%.
Which gives you a nice 10% return, which is very, very solid, I would say.
Yeah, and I'm not counting in anything that I might sell at a profit, because I'm not doing that anymore, right? But I'm at a stage where everything I'm investing in, I'm keeping, and it's just reinvesting. And because my business is doing very well, I'm able to now maximize my SIP allowance and my ISA allowance. So my kind of savings rate is increased exponentially, which means that Snowball Analytics that I use tells me that the current rate of new money coming in, I'll probably hit my income that I want for retirement in about 2 to 3 years. So that's really what I'm shooting for.
No, and then last week we were talking about high yield investing, right? So let's assume you have a portfolio income of about 7%. Are you feeling comfortable to hit the mark directly at 7% expense crossover point, or do you create a buffer for yourself? How do you look at that?
I'm comfortable with 7%. Yeah. I am.
Okay, but you don't feel like you need to have a buffer for, let's say, economic slowdown, that you think like, okay, let's take a 20% margin on my expenses, right? So financial independence viewed from the passive income crossing your annual expenses, let's say. Do you feel like you need to have kind of a margin of safety in there, or do you feel like, no, that'll be fine?
I think I'll be fine. I might think about a margin of safety, but I kind of live a very, I won't call it frugal, but it's a very humble life, right? I keep my expenses quite low compared to my friends, family, peers, who are at the same level in their career as I am. So I kind of tend to live a life where I don't think it's boring. I mean, I think we do lots of interesting and fun things, but I'm not extravagant at all. I don't feel like I need to have a 5-bedroom house or 2 luxury cars and go on 3 holidays per year. That's not the kind of life I like. And a lot of my pastimes are very much about, being at home and working my hobbies or following my hobbies. I'm a very kind of, I live a very simple life. I'm really into stoicism and minimalism and things like that. And so I kind of really feel comfortable. I know a lot of people, for example, used to say to me last year, oh my God, the inflation rate, the cost of living crisis. And I never call it a crisis. Crisis is when you can't feed your kids, right? So it's not a crisis, right? So, I kind of look at life in a way where if people say, my God, the cost of living is so much, food is so expensive. Well, on average, people waste 20 to 30% of the food they buy. So why don't we just buy 20% less, and inflation's not a problem? Or, and I've been in a position, if you can believe, 42 years old. I'm 56 now. At 42 years old, I was absolutely broke. Right, I was absolutely broke, and I had no money. I owed money. I had debts, and I actually had to dip into my daughter's piggy bank to buy bread and milk. That's how bad it was. But we had a roof over our heads. We had heat. We had plenty of food, enough food to eat. And so I kind of feel like at a 7% rate, I don't think I need a buffer. I think we can adjust to cope really well.
And I think, myself as well, I've seen some poverty in my life. And I think once you experience that and you get out of it, still with happiness, you can survive a lot of things, and that you don't need a lot to be happy, right? And that makes it also easier to avoid lifestyle inflation and to also be more precious with the stuff you spend, the money you spend.
Yeah, I kind of lost the chase for money at that time. I kind of stopped caring about chasing money, and I just kind of decided to have faith that it will come in time when I'm ready for it, and it did. So yeah.
Awesome. Yeah, because you kind of lose that sense of keeping up with the Joneses when you go through something like that, and it's
absolutely
something I had myself too. So it resonates quite with me. But if we look at the makeup of your portfolio, I know you have 16 holdings in total. I think 6 of them are funds, I believe.
Yeah.
And Thomas Van Bent has asked, what's your process like? How do you select what you're going to pick, a fund or a stock?
Okay.
How do you make that decision when you're adding to your portfolio?
Yeah. So let me just pull up my notes, because I actually did. So my process at a high level, what I screen for at a high level, I look at companies, I'm talking about companies now in terms of screening, right? So usually more than 10 billion as a market cap is what I look at. I look at where that company is positioned in terms of its 52-week high and low. So if it's below 50% of its 52-week high, so let's say from 0 up to 50% above its 52-week low, I get interested in that company, right? As long as it's a solid company. I look at more than 4% dividend yield, my current ratio of 1 or above, debt to equity of 50% or less, and a 10-year or more dividend streak. So once the company satisfies those, then I'll get interested in looking at it further. So then once I've found that type of a company, and I use Koifin as well as a platform, and so you can have a screener in there, and so I put those metrics into the screener, and so that will pop up some companies that I will want to look at. Now, once those companies come to my attention, I'll have a look to see whether it's the kind of sector I'm interested in, and as I said before, does it produce a product or service which we just can't live without? That really is interesting to me, and then I'll compare it against 2 to 3 of its largest competitors, and then for the best one, I'll do the 10-year financial statement analysis and a DCF calculation. So really, that's the high level kind of criteria that I'll look at to pick the stocks. And sometimes for inspiration, I use my own experience as well. So currently I'm, working on a project which is SAP. It's an SAP project, and you kind of start to understand how complex but extensive SAP is and how many companies use it around the world, how many large companies use it. And so I started to look at ERP companies, and I looked at SAP versus Oracle versus Sage. I actually found whilst SAP is very investable, Sage was actually even more investable, right? So that's the company that I wanted to invest in. And I get attracted by news stories, large, well-known companies, especially when large, well-known companies lose market cap or share price drops significantly. I really want to look into the reasons why that's happened. So great examples like that is Coca-Cola with the current IRS litigation, or a news story that's happened recently, which is Visa, which, the DOJ are looking at them, whether they're a monopoly for debit cards. Those kind of large company stories where there's a possibility that the market sentiment will drop that share price unnecessarily. Those are kind of things that really interest me. And so those are the kind of criteria I look at when I'm looking at the companies. And generally, it's more I get just alerted by them rather than actively going and looking for those.
And what does your top 5 positions look like?
My top 5. Let's have a look. So in terms of just individual companies, I've got Realty Income. I've had that for a long time. Current yield on cost is 5.1%. That's the monthly dividend company. I really love it. I've held that for a long time, and I've actually gone through a period where I was kind of trying to invest mostly in REITs. I wanted to become just a REIT investor, but actually, as I went through year by year, I kind of realized that there's only really one company I want to keep accumulating, which was Realty Income. So that's one of them. Lloyds Bank. The Lloyds Banking Group is another one. It's current 5.03% yield on cost. The reason why I did this, now I agree with you guys, the bankers are wankers, right? But
I'm just looking at your PD Joy's face.
yeah, I did as well, and I do agree.
Yeah, you made me chuckle a little bit.
Yeah, but I kind of felt if I'm going to invest in things that we can't live without, we all know that we can't live without banking. Sorry, especially as you get older, it becomes more important. And I'm talking about banking now, right? But
okay.
But the reason why Lloyds, it was 50 pence per share, and I thought that can't be right. This is a 35 billion market cap company, right? It has revenues of I think it's 3.5 billion. No, revenues of about turnover about 17.8 billion. So how can this company, never mind it's a bank, how can this company be 50 pence per share? So I compared it to larger, well, not even larger, but peers like HSBC and Barclays, for example. And I found that the key banking metrics, efficiency ratio, net interest margin, loan to deposit ratio, the CET1, they were very similar, right? Or if they were different, or HSBC was a bit higher, it wasn't significantly higher. And those, in terms of share price, was significantly higher than Lloyd's. And I thought, well, why is that? So I looked into it. And I like Lloyd because it's very much a simpler bank than the others. It's very much retail focused, right? It's mostly consumer banking and business and corporate banking, not as diversified as the others, and they don't take on as much risk as the others. And the reason that its share price was so depressed was because they'd been through a number of they've been in trouble with the FCA, right, for a number of things like auto loans, for example, mis-selling and things like that. And it'd gone through that process, and it was starting to come out of that, where they had paid off a lot of the fines that were levied against them. And so it really felt to me that 50 pence per share was just such a discount that I just couldn't ignore it. And it is a big bank in UK terms, right? And so that's why I kind of invested in it, because the yield was so great. Now, I kind of feel like that within the next 6 to 12 months, I think that share price should be £1 at least, right? If not more. And at that point, I might sell it. Following my bankers and wankers philosophy, I might sell it and then deploy that elsewhere into companies that I would rather. But at the moment, the yield is good, and I still think there's growth possible in there. So that's Lloyds Bank. Canadian National Railway is an interesting one. That does not meet my 4% kind of threshold in terms of yield. It's 2.16%, but that's actually quite unusual for Canadian National Railway or any of the big North American railways. They're usually 1% or even less sometimes. But I always wanted to invest in one of these companies. Again, a company that the North America just cannot, and Canada especially, can't do without. It's one of those infrastructure, transportation, logistics companies that the Canadian government is too big to fail. It's too essential to the economy for it to fail. With the labor kind of disputes that they had recently, I mean, the Canadian economy in terms of GDP was losing hundreds of millions per week, right? So it's absolutely required. And I think this was a rare opportunity to get in at a decent yield. And so I bought into it very recently, actually, Canadian National Railway. The other one is INPP, which is International, sorry, I forget the full name of it, International Public Partnership Company, I think it is. INPP is one of those companies that basically engage in public-private partnerships for large infrastructure projects and investments. And the reason I was interested in this with a dividend factory, in a dividend factory ethos is very much US led, and there's a part of their portfolio which is invested in senior debt ETFs, which we can't get here. You know, there are no ETFs that do that. And so I wanted something that was kind of like a proxy for that. And I felt that, you know, a company that partners with local and national government in big infrastructure projects is kind of like a proxy for a senior debt kind of ETF. And so it was a way of allocating a percentage of a portfolio into a long-term senior financing or capital initiatives, you know, that are secured by government. I mean, there's a 1 year total return on that of 13%, and a 5-year CAGR is 3%. But it's one that, you know, is very well priced. It's 6.5% yield, which I really love. So that's something that I'm invested in. And then the other one for single company is Legal and General. This is one that I've had for a long time, 9.2% yield on that. And I've held other insurance companies on and off over the years, like Aviva or Royal Sun Alliance, etc. But I've always found, you know, the Legal and General to be a solid player. And I think I did do a discounted cash flow analysis on it, but when I look back at it, I'm not really satisfied with it because insurance companies really have their own nuances, right? And I think you would need to adapt your analysis method specifically for insurance companies. It's the next thing I really want to learn how to do, including REITs as well. I really want to learn how to do that, and that's on my agenda to do that next. But yeah, so those are my single companies: Realty Income, Lloyds Bank, Canadian National Railway, INPP, and Legal and General.
Awesome. And I was just looking at my Legal and General holding as well, and it's one of those insurance companies that definitely has the highest yield. So far, it has been disappointing in share price, so to say. It's already full position for me. For me, it can now nicely go up in the air, of course.
Yes.
But it's a solid business, I think. There has been some movement lately there again, so I would need to revisit it a bit. But I love European insurance companies at the moment. The yields are still decent compared to the rest of the market, and specifically their US equivalents, which I find very, very high priced, and specifically also knowing that the business model seemed to be a bit more solid here. I don't feel like we're ripping off European consumers as much as maybe they do in the US.
Yeah, I tend to agree with you there, because I think in the US, and I have a lot of friends in the US as well, and I talk to them a lot, and it just seems like US insurance companies tend to rely on the fact that, you know, denying claims is the way to profitability. Yeah. And I don't think European insurance companies are as aggressive in that respect.
Exactly.
Yeah.
Hey, you mentioned now a few stocks that you do own, right? But what is there like one stock, let's say, that you would love to own at the right price, but you just never got it yet? Like you've been chasing it, or maybe even it dropped one time to your price, but then it flew away again from you. Do you have such a stock?
Yeah, I think Coca-Cola is one, and I want to make up for past indiscretions where I held Coca-Cola at a good price and then I went and sold at a little bit of a profit. Coca-Cola is one that I've always wanted at a decent price. I think my buy price is about $48.50. I think is my buy price. So I'm hoping. I mean, it's, you know, this is one where will it ever go down to that level? I've kind of found in my experience that if you wait long enough, it will at some point, right, get there. And especially considering their current troubles with the IRS, an opportunity to get in there. So Coca-Cola is one of them, and the other one is actually Air Products and Chemicals is one.
Oh, yes.
Yeah. My buy range is $160 to $177. It's currently at 314, so I may be waiting a long time. But again, it kind of satisfies my philosophy of investing in things the world can't live without. I've always wanted a materials company, a chemical producer. And I did a comparison against companies like BASF and Johnson Matthey. And APD wins on net asset value per share, has a much higher gross EBITDA and operating and net margin, a significantly better economic value added. EVA, I call it. EVA is essentially the difference between your return on capital employed and your weighted average cost of capital. And it has a great interest cover. It kind of beats the other two on all of that. And the one thing I like
also not
is,
hard to beat BASF at the moment.
yeah, it's not so hard. Absolutely, absolutely. Yeah, yeah. And it's weird. I think there was a listener who asked this question. I seem to remember. But see, with these two, especially with air products and chemicals, it's kind of difficult when you think this is a company I really want to add to my portfolio. You derive a buy price, but it's so far from the current price. You kind of wonder, is it ever going to get there?
Exactly.
Will I ever add it to my portfolio?
Yeah.
That's a difficult one.
Yeah, nice one. And you know what the nice thing is, even if you make a mistake in the ticker symbol with APD, you still end up with a high quality dividend stock in ADP.
ADP, yeah, that's true.
So you really can't go wrong with that one.
That's true. Yeah. So those are the two that I would really love to have on my in my portfolio. Yeah.
Nice, solid picks. And listening to your 5 stocks that you pick, it was actually quite interesting because there was a nice mix. There was companies with, I would say, low yield compared to what you're expecting, with Canadian National Railway, but they have some high dividend growth. You've got some high yielders with low dividend growth, and then you've got real income in the mix. It was actually quite a balanced approach, which is what I wasn't expecting considering the high yield of your portfolio. So it was quite nice. But a question I have then is, I suppose we asked this to nearly all our guests that we come on, but what are some of the learnings that you have, and what advice would you give to someone that's younger or starting, or to yourself back maybe in 2003?
I think one of the things I do advise people who ask me, and it's because this worked for me, is to be a natural contrarian, right? Don't do something because everyone else is doing it. I'm a firm believer in this. I think it's more often wrong than right when you follow the crowd, especially these days. I kind of find when social media drives people to jump on the bandwagon and ride the wave without actually doing the work. Sometimes very often it's for likes or YouTube subscriptions to generate revenue, things like that. So, learn to be a natural contrarian, that if everyone's doing something, whether they're investing in Nvidia or Tesla or whatever, don't just do it. Ask yourself why. Why are they doing that? And look into it and do the work. Read lots is another thing that I advise people. You never miss out when you learn to read and read often, right? I think there's a lot you can get out of that. The big one I would advise people is learn how to take calculated risk, right? When the time comes, have the balls to take those risks if it's a calculated risk, right? Even more so when you're younger, I think, and you have plenty of time to make up for those risks that didn't work out. I mean, it's okay to fail, if your rationale for taking the risk is sound. I mean, life doesn't always work out for the best play, and I learned that all the time in poker, actually. You can't, you can go all in with the best hand. It's not always going to work out for you, right? But over the long term, it works out in your favor.
Yeah.
But learn how to take calculated risks. I think it's an important one. Starting early is the obvious one.
Yeah.
Right? Time in the market is so important. And I learned that, and I tell that story about, the British war veteran who invested and his wife, inherited 2 million. I tell that story a lot. So starting early is obvious. The other one I actually find, because we live in a very noisy world with lots of content being thrown at you all the time. And I think this is good for in life as well as investing, is have periods in your day when you do nothing, right? just a period where you just sit there and do nothing. And the reason for that, I've found, is that if you sit there, do nothing, try and think of nothing, some of the most amazing things will come to mind that may not have, because your mind is crowded by outside noise. That's an important one. And then the other one is keep things simple. Don't overcomplicate your life, whether it's in investing or other things. I think keeping things simple is very important. And then final one, the big one for me, in investing, in life, career, all of that, the big one is when opportunities present themselves, don't let them pass you by and not give it a go, even on paper, right? Trying and failing, I think, will always make you feel better in the long run than having the regret of what could have been if you had tried, right? So I think, if you see an opportunity, whether it's investing or career or in life, look into it and give it a go. Even theoretically or on paper, it will work wonders for you. So those are kind of like the advices I would give to my younger self and anybody else.
What I think you mentioned about calculated risk, I guess that's something that I typically consider as you can't borrow conviction.
Yes.
Because it means you've done your homework. Then is the time to double down on it, right? That is the time, because why else do you do all this homework? You start to like the business, you feel you understand the business. When is then the best moment? Yeah,
absolutely.
That you can't take it from influencers. And I know we have a podcast, right? But we are hopefully rather on the inspiring side, because we tend to not give any stock picks or stock advice anymore, but rather try to teach people a little bit more like how we do it. Yeah, and then that's up to the individual to see what they will do as well. But many of the questions we get are like, what do you think about this stock? What do you think about that stock? Really to get a clue out of it. Would you buy it? Yeah.
Yeah. I mean, I think these are like Dividend Talk and others that I follow are great, but you got to look at them as signposts, right? They're signposts. It's up to you to take the journey and
Exactly.
take a choice which way you're going to go. And I think really, taking that risk and having the guts to go for it. I mean, I use the analogy of poker and going all in, but a great saying, great thing that I always quote from Peter Lynch is, when the right time comes, back that truck up, right, and load it up, because you've got the opportunity. And the other thing I always quote, because I'm a poker fan, and there's a film called Rounders. You may have watched it. But in it, Matt Damon says, get your money in when you have the best of it, protect it when you don't. And that's really a great philosophy for investing, poker, but also for life, right? The opportunities come, go for it. And I've never kind of regretted that.
Awesome. I have so many questions around poker and investing. I like poker too, so you're a man close to my heart here. And there's lots. You're right. There's definitely lots of parallels in it. And calculated risks is one I agree with. I can also see you follow your advice on reading lots of books. I can see behind you there's at least 60 books there. So it's
that's about that's a third. It goes on that way.
I could imagine.
Yeah,
I could imagine.
Yeah.
But listen, it's for me, it's always really inspiring to hear these types of stories, and considering the ups and downs and challenges and what you've learned along the way. And it shows that you can make mistakes. You can wait a little bit longer than what you should have, but success is still only around the corner if you put in some of that work and effort. And I'm so happy for you that you're so close to it. You mentioned 2 years away and maybe sooner. So it's so inspiring, and I think our listeners will take a lot from that. On that, our listeners have some questions for you. So we won't hog the questions anymore. We'll hand over to some of our listeners. And Marcus is one of the first, and he's asked, how did you cope, or how are you coping with the boring middle?
Yeah, for this one, so I saw this question already, and I kind of thought about it, and I kind of find that it's a good way to it's a good idea to find successful investors that you would like to be like, right? And I think Monish Pabrai unapologetically says, I'm a copier, right? I look at successful, I just copy them. I have no shame in doing that. And that's a good thing to do. Read about them, watch their content, try some of their strategies, and that's a small part of the fun in your portfolio, right? If you really like investing, if you look at this stuff and you find it boring, maybe investing is not for you. But if you find it, interesting and fun, then that's a good way to do it. I also think it's good to have a portion of your portfolio that I actually call my fun portfolio. And maybe it's about 2% of your total. That's what I use, 2%, right? And with that, I try new ideas out. Maybe I want to try punting on penny stocks, or maybe I want to, kind of think about crypto. I've always been against crypto throughout my whole investing career. I've only recently decided and finally understand what crypto is, right? And I've actually put a little bit of money in, not much, maybe like a couple of £100. I'm kind of looking to go accumulate up to 0.08 of a Bitcoin and just stay there and wait for the future, right? So trying things out with a fun part of your portfolio will make things fun, and not let it get too boring. But I think ultimately good investing is boring, right? Speculating is more exciting, but you're much more likely to lose your money. And again, I'll quote Peter Lynch when he said, "If you want excitement, take your money to Vegas," which I do from time to time.
Yes, me too.
But I don't think we should be looking to keep investing always interesting. I think we should be keeping our life outside of work and investing interesting.
Yes.
Right. So for me, poker, I love ice hockey. Coming from Canada and living there, ice hockey is a big passion of mine. And I do a lot of other stuff outside of work and investing, which keeps my life interesting. So I don't expect investing to be fun or interesting, right? I expect it to be boring. And there's certain things you should always remember, I think, when you do start to get bored, there's certain things that would be good to remind yourself. So it was only today, actually, or yesterday, I was looking at this guy on YouTube called Compounding Investor. He's a British guy. And his latest vlog, he revealed that it took him 12 years to grow his portfolio from 0 to 250K. And to get from 250K to 500K took him 3 years. And that's just astounding to me. So if I ever get bored of investing, I'm going to keep reminding myself about that, right? And so, I mean, it's really surprising, that. And actually, the other surprising thing was he's got a 500K portfolio. My portfolio is a lot less than that, and yet his average monthly dividend income is the same as mine, which was really, really strange to me, right? So I know I'm doing something good, right?
Yeah.
But yeah, those are the things I kind of think about or look at when I might be starting to feel bored. But I haven't ever gotten bored of investing, whether it was early, middle, or now.
Yeah. Nice answer. I think the advice around keeping your life interesting and your investments boring is quite good. Thomas has asked us a question, and it's about the side effects of learning. The more you learn, the more you see the imperfections. And you use a funny kind of quote here. It's like buying a 4K TV. It's great until you see wrinkles and imperfections and all the ladies that you seem to like on the screen. But on that, he's struggling now to choose one company that fits all of his criteria. So then he lacks conviction. So is it just him who has that kind of feeling? Do we have that kind of feeling? And if so, how do we deal with it? Or should he just give up on having this criteria altogether?
I think there will always be times when you kind of compromise your criteria a little bit, right? And you invest in companies that fall a little bit outside of your criteria. I think if those investments are not successful, then it will validate the strength of your original criteria, because you went outside of them and you weren't successful. You think, okay, my criteria are good, I should stick with those. And you'll be less likely to compromise them the next time, right? But if the investments are successful, then it's a good learning experience. I think what it does is it drives you to reassess your criteria and refine them and make them better. So I think if you kind of act outside of your criteria, it's not always a bad thing. I think it's a great learning experience, as long as you don't significantly do it to the whole of your portfolio. You don't want to do that. But over time, I think you land on a set of criteria which you have learned to never compromise, no matter how juicy the opportunity is. Um, in a lot of ways, I kind of look at it like in the early days, it's like picking a woman or a man, depending on who you are. You just, you just get better with it over time until you land on the one you want, and you stick with it.
Yeah. I mean, if it was me, I would probably rank or put weighting next to my criteria, because not all of them will have equal weighting. And I would have my top 3 or 4, and they're my must-haves. And if a company hits that but doesn't hit the lower ranking ones, and then maybe give them a chance. But if a company doesn't meet my top ranking criteria, I would probably stick to them. It's not stay away from them.
That's one thing I've never done, and I think it's really good. It's really good that you do that, and I think it's something I might want to try and do next. Because you always want to keep evolving, right? And I think if I have a set of criteria, if I weight them, I think that would make it even better. Yeah.
Hussein has asked us, let's say you have enough capital for both. Which would you choose? Buying a flat to rent out or invest in real estate investment trusts?
Well, that's an easy one. I'd invest in a REIT. I would always invest in a REIT. The reason for that, I know a lot of people who rent out property for an income. I would never consider it a passive income, actually, when I see what they go through, right?
It's tough.
Yeah. I mean, the last thing I want, like if I was renting out property, last thing I want is I'm ready to watch a hockey game or play a poker tournament or spend a public holiday with my family. Yeah, a tenant calls because their kids flooded the bathroom and the ceiling's fallen in. That doesn't sound very passive to me, right? So, but also the other thing is that if I'm lucky enough to buy a flat for, let's say, 200,000, 150,000, 200,000, to me, that's a lot of money invested in one asset.
Yeah.
It kind of goes against my idea of diversification, to be honest. I could actually invest 150K into 5 different REITs in different sectors and enjoy a truly passive income that compounds, right? So it would always be REIT rather. I've never really been into buying a property and renting it out, not least of which because I absolutely hate mortgages.
Yeah. And one thought that crossed my mind when you were saying that is, what if you want to sell or you need to access that money at some point? It's hard, one, if you have a tenant. I don't know I know the UK is similar to Ireland. It's not easy to get the tenant out in a timely manner. And then once you do, you still have to put it on the market. You have to sell, you have to wait. Whereas with real estate investment trusts, you can sell them instantly and have that money. So that would be a factor for me too.
Yeah. And in the UK, under the new Labour government, it's going to get very, very tough for landlords.
Yeah, yes. It's similar to Ireland. It's not a landlord-friendly environment this side of Europe, I must admit.
No, not at all.
What's your take, European DJ?
Can't really add anything more, guys.
Fine.
I'm just sitting here listening, and I think like, wow, okay, this is going great.
Incidentally, I did a long time ago. I got my spreadsheet out and I did an analysis where I said, okay, here's what I would pay out on a mortgage, including the insurances and interest and all that stuff, and here's what I pay out on rent. And the difference was I paid at that time about £350 per month less on rent. So I said, okay, over 25 years, 150K for the house mortgage. If I rented for 25 years and that £300 or £350 per month, I invested it and compounded it at a modest 3%, after 25 years, that 150K would be 800K. Now my house would have to be worth that much for me to get that same return. It just didn't make sense to me. So I've never bought a house on a mortgage ever since.
Yeah, it's interesting. And you know what? I find that a lot of people in the UK have a similar thought process with that. I have lots of friends over there.
Yeah.
And they rent rather than own houses. And it's quite different over here. So it's an interesting aspect. And of course, after that time, you could buy that house outright because it won't be it won't be worth 800,000 by that time.
Yeah,
So,
absolutely. I mean, next year I will be in that position if I wanted to do that, because my wife really wants to buy a house, and I'm kind of already starting to put some feelers into her while she sleeps, whisper in her ear, yeah, 300,000 means this much income per year. Do you really want me to spend that money on that house?
subliminal messages while she's
That's right. Yeah, that's subliminal. Yeah, absolutely.
RMS has asked us about closed-ended funds. I'm sure you have some, but how do you value them? He reckons NAV does not seem to be enough. Do you use a discounted cash flow, for example?
I don't, and I don't actually have closed-ended funds. I don't really invest in actively managed funds at all. There's been quite a number of studies done. There's another kind of similar group that I'm a part of called Pension Craft. It's very much UK based, and it's more around people who are about to retire or who have retired. But anyway, one of the kind of studies that they did was around active versus passive funds. And it's very rare that an active fund outperforms a passive fund. They don't most of the time. 80% of the time, they don't at all, right? So I don't do that. But it's an interesting question around valuation. I struggle with this one because I haven't really been investing in ETFs for very long, and because I'm very much into DCF and fair value with individual stocks. The only thing that I've thought of, and maybe there's a lot more that I should think about it, is to really look at the current price per unit of an ETF or price per share of an ETF against the net asset value per share. But it's very hard to get that data. I think Morningstar US gave net asset value per ETF, but Morningstar UK doesn't. So I'd love to find a source where I could, for the ETFs that I'm invested in, find net asset value per share. And compare that to what the current price is, but I haven't found a source for that yet.
Yeah. I think in terms of closed-ended funds valuation, typically NAV is what is used. I'm nearly sure in the Income Factory he also talks about discounted cash flow. So you can, of course, do both, but in my experience, it's always been about the NAV, the expense ratio, and the leverage of them. You take those into consideration.
What I think is also important is the NAV relative to price over the last 5 years.
Yes,
yeah, because that gives also an indication how the market has been valuing that asset over the last 5 years, and that seems to be a pretty reliable indicator there.
Yeah.
Hans de Jong has asked us about currency risk. Do you take this into account when you are investing?
I don't actually. I haven't really factored that in. I think it's very difficult to do that, and I've never even considered looking into it, to be honest. I just saw it as a cost of investing, So I've not really looked into it. I don't make any decisions based on that.
Yeah.
If I find a really compelling stock in the US or that I really want to invest in, and a similar one in the UK, I usually go with the stronger one, and I don't really take FX into consideration.
Okay. And then what about from a European perspective? Because we've got the Swiss franc, we've got Swedish crown, Danish crown, we've got all sorts of currencies even in Europe. Would you have any issue in investing in those, or would you stay away?
I don't have any issue in investing in those, but recently I've really started to take into consideration withholding tax.
Yes.
So I do kind of tend to invest in either the UK or jurisdictions where we have a treaty, like the US with a W8BEN, where you can where you can kind of reduce the amount of withholding tax. Other jurisdictions like Denmark, so I hold AP Moller Maersk company. It's one I'm going to sell, but it's underwater at the moment, so I'll wait until it comes back up. But it did used to give a very, very good dividend, but you have to apply, and I think I put the post on Facebook recently where the Denmark have a very easy online way of applying for your withholding tax, which I thought, wow, great. So I filled it in. It was very quick. I pressed submit, and there was a message that said it will take us 18 months to process your It's like, Jesus, 18 months, really?
Well, that is what it takes to go from an inbox getting forwarded to the right clerk in the tax office there.
I thought it must be very laid back in Denmark over there,
El Kuba has asked about your thoughts on insurance companies in Europe. European DJI, probably more tailored to you. I would
Yeah,
say.
I just mentioned it already. I think it's still one of the best industries. When you think about a nice combination of yield and growth, it's a tricky one because from one side, when the interest rates rise, they benefit from it, but also have some downsides, like their asset portfolio will be worth less effectively, right? And on the other side, when the rates drop, then the asset portfolio is much more worth, but maybe the float is different. So all in all, generally, I would say that probably a declining interest rate will do those companies a bit better than where they've been trading at over the last 2 years. But for me, like I mentioned, it's one of those few very attractive industries still. It is just like that, how much can I get in my portfolio, right? At a certain moment, I've got overexposure, and I have a feeling that I have that.
Yeah. Richard has asked us about Glanbia. Glanbia is an Irish nutrition company, and Manny, you said you spent some time here in Ireland. Do you know the company at all?
I've heard of the company. I've never really looked at it closely, but when I saw this question pop up, I did have a quick look at it. Looks quite interesting. It's I think it's about 12% above its 52-week low. It's 4 billion market cap. I think dividend yield is about 2.7%. And from the perspective of my ratios, like current ratio, debt to equity, it looks really compelling. There's one thing that kind of made me wonder, that Turland Cooperative holds about 29% of Glanbia.
Treeland. It's the other way around. So Treeland is like the Farmers Corporation. So
right.
They had to be bought out. There was a whole lot of jiggery pokery for them to be allowed to.
Yeah. Well, the question I had was, they've recently voted in favor of removing this rule, which restricted them reducing that holdings in Glanbia, and I'm kind of wondering why did you get rid of that ruling? You really want to sell Glanbia, and why? Right? I don't understand that. Yeah.
So Glanbia is quite an interesting company, and funny story is it started in my hometown. So it's a company where everyone Waterford, Kilkenny, that area will know Glanbia and throughout Ireland. And growing up, I always associate them with cheese and milk, because that's primarily what they've done. This Treeland is now, say, your milk part, and this is what we'd know in Ireland. You'd have these glass bottles that would be delivered to your doors, and it still happens in some parts, not as often as in the 80s or 90s, but it still happens. But Glanbia itself now has transitioned itself into like this global nutrition company, and really, really good story. It's not until I did a deep dive on it, I think about 4 or 5 months ago, that I realized that they were so big in global nutrition. I knew they had that portion, but I didn't know it was the main business. I thought the cheese and milk was. So you're completely correct. It's a compelling company. The Treeland business is nothing to worry about. It's the co-op side of it, and it's the milk and the cheese, and it's separate to the global nutrition. For me at the time, it was the valuation was quite high, but they were trading at around 16, closer to 17 euro. I think they're after dropping off around then. So that was my only issue at the time. Dividend has growth. I can't remember if it was 30 years. It was quite strong. So they're really committed to the dividends, and of course, America is their biggest market. So maybe I'm expecting them to go over on similar to what CRH did and go on to the US stock exchange, because they kind of flirt between the top 10 and 11th in that industry. And I think if they want to break that barrier, they'll have to go to the US at some stage. And that's where most of their sales are.
Yeah.
So I could see that happening.
I got a feeling that Treeland just simply wants to be free of this restriction, just so they can cash, because Glanbia Holdings doing very well, just cash in some so they can be a bit more flexible in what they invest in, right?
Exactly. And they can stick to their business, which is milk and cheese, and Glanbia can stick then to protein and making people big and strong. So Richard, to answer your question, I think it's a really good company. For me, it was valuation. It was the second company I ever bought in my portfolio, and yeah, it's one I would definitely consider owning and buying more of if the valuation matches what I had. Christian has asked our opinion on Pernod Ricard.
I have no opinion on it. I haven't really looked into this company, so can't tell anything about it. What about you?
I have one share which I bought as a testament to the fact they own Jameson's, which is one of my favorite drinks. And I found out about that on the show. Remember, I can't remember, maybe 2 years ago, someone had mentioned this company. We looked them up and they were at Jameson's. I was like, oh, it's my favorite whiskey. So I had to buy one share. But honestly, I haven't looked into it deep enough after that. I know I did some valuation on it and it was way outside of what it was. So I was like, why waste time analyzing it if I'm not going to actually buy it? But yeah, I'd say it's a competitor to Diageo. I don't know if they're struggling just as much as Diageo at the moment, but from what I know, they have some strong brands, and it was just a question of valuation which steered me off them.
I think I'm glad this question came up actually, because when I look at my kind of criteria, it does meet a lot of the criteria. It looks really compelling, and it's a big company. I think it's a sector worth looking at. I don't have a consumer staple in my portfolio, and although strictly speaking, alcohol is a consumer discretionary that acts like a staple, right? If you know what I mean. I think it's worth looking at, and if I was going to do an analysis, deep dive on a sector, I'd probably do this one. Look at the Diageo, Constellation Brands, Bacardi, those against Pernod Ricard, and see where it comes out. I don't think I'd look at Heineken, Carlsberg, Molson against it. I think I'd probably want to do that separately as more like a beer focused company.
I'd agree,
but it's worth looking into, I think. Yeah.
I quickly checked the share price and it has dropped significantly. It's nearly €100 off. It's trading at 126. So this one might be worth looking at it, comparing to Diageo.
Yeah.
Awesome. That was the last listener question that we have. And usually when we have a guest on the show, it's not a recommendation. You can pick anything you want, but we normally ask them if they give a stock pick of the week. So if you had to pick one stock, it can be stock, ETF, fund, whatever you want. Is there anything you would recommend our listeners to do more research
on? For ETF, the one that I'm really accumulating is TP05. It's US Treasury 0 to 5 year. It's got a great yield actually for a bond fund. Let me have a look. It's 7.59%. With a stock pick, my screener on Coifin looks actually throws up T. Rowe Price and Franklin Resources a lot, right? PROW ticker and BEN as a ticker as well. And I like both of these companies. I've got bank and insurance companies, so I'm kind of thinking, do I want another one in the financial sector? But I don't have one in capital markets, right? So it's something that I'm looking at. It's Franklin Resources has a higher yield, although T. Rowe Price has much less debt. So I really want to think about which one I would want to invest in if I wanted to add that to my portfolio. So, but they're both very compelling.
Yeah. If I was to pick one of the two, T. Rowe Price's balance sheet would win out all day.
I think so, and I think Franklin Resources has had a lot of capital outflows recently, right?
Yeah.
Good, Manny. This brings us to the end of the show, and it was really interesting to hear you talking. And also, I mean, last week, then we got this email, and you today with a more higher yielding portfolio really makes me think sometimes like, okay, should I tailor a little bit again here and there my portfolio? So far, I'm like to your point. I'm taking. How is it? You said like you use other words, but don't listen to others necessarily. Be contrarian. So far, I'm trying to be contrarian, but yeah, I guess I don't hate my job as much enough
Yeah,
yet.
absolutely.
Thank you so much, because you gave a bit of a different voice on the show here, which I think only adds to the diversity of our I would say our guests, and hopefully inspired a lot of people as well. I'm sure they did, and I also hope that they further engage with you on Facebook. Are there any other social media outlets where they can find you, Manny?
I don't really do social media. Facebook, the only thing I do on Facebook is Dividend
It's
Talk.
the group. Okay,
Your
good.
group, and that's all.
Good.
LinkedIn is the only other one that I'm on, but that's more
Yeah.
career based.
Yeah.
But I did. There was one person who wrote a question. It wasn't a question, but it was more. Can you tell us the individual tickers of what you're invested in? We didn't really mention the preference shares
Yeah.
that I invest in. So I will go on Facebook and I'll post all of the ticker symbols for everything that I own currently in my portfolio.
Awesome.
Yeah.
Well, thank you so much once again. And yeah, Derek, any last words of wisdom for you?
No, it just shows the power of our community. We've got so many inspiring people, emails we get, Facebook posts, and to have you on the show, as I said, it's been a pleasure of ours. I've really enjoyed this. I could have spoke to you for hours about this if I'm honest. I had to force myself to stop and move through the segments. So look, thank you so much for coming on. We really appreciate it.
Thank you for having me on. It's been really fun, and I love this group. This is the group that I follow all the time. So you're doing a great job, guys, and I think more continued success.
Thank you.
Awesome. And to our listeners, we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.